So I just recently wrapped up an IRS audit for one of my clients, and we learned a ton during this audit. So essentially the story is one of my clients, they invest in short-term rentals. They have a high W-2 income, they're married filing jointly with some kids, and they invest in short-term rentals. They've been doing this for a few years and taking the deduction, but they recently got selected for audit because they did a cost segregation on their short-term rental, and here's everything that we learned. So first off, how does an IRS audit actually go? So the first thing that happens is you're gonna get some type of communication in the mail. They'll send you a letter saying, hey, there's been an adjustment. Can you go ahead and send us some documentation, confirming this? Or they'll just straight up say, hey, you have been selected for a field audit. And what's in this IDR is they'll list out all the different things. They'll say, hey, on your Schedule C, line 5 or line 6, whatever, they'll select a line and they'll say, hey, give us all the documentation and information for this deduction right here. And they'll go through, they'll do that for your entire tax return. This particular case, it was a short-term rental. They wanted to look at just a few things. They wanted to look at their mortgage interest, they wanted to look at their depreciation, and then the big one was they wanted to look at their time logs, because whenever you start talking about real estate and short-term rentals, they're gonna look at real estate professional status, or did you materially participate in your rental activity? And that's where things got really interesting. So as the audit started, we actually provided all the documentation right up front, and it looked really good. It gave us a lot of credibility. For the mortgage interest, they wanted to see 1098s. For depreciation, they wanted to see the depreciation schedule and all of the receipts that we use for improvements. And they also wanted to see the cost segregation report that we use to come up with the accelerated depreciation. So during the audit, we actually gained a lot of credibility with the auditor because number one, when they asked for the information, we got it to them in a timely fashion. Number two, the client was extremely organized with all of their bookkeeping and receipts and everything that you would need down to a T. And that was shocking to the auditor. They had separate bank accounts for all of their rentals, for all of their businesses, and they had receipts for everything. It was a gold mine. And this was huge because the auditor was actually blown away, and it really helped us move forward, and we actually had a no change to the audit. And that was huge for my client because they saved thousands of dollars in taxes using this strategy. It was a huge win for me and my team, and I wanted to share that message with you because the biggest thing that I learned from that audit is documentation and organization. Make sure you have all of your documentation. If you're gonna be claiming real estate professional status or short-term rentals, have your time logs. Make sure your time logs are detailed. Don't do some drag and drop talking about I did some repairs and maintenance. No, what did you repair? What did you maintain? You went up and repaired the toilet on the second floor and it took you 35 minutes using XYZ materials, right? The time it takes you to do the details right the first time will save you a headache in the future should you ever actually get audited.